I don't like that lady. All right. The plan for today is to, so we've been talking through infinite banking concept. Last week we had Leroy talk about his Mech method, talk about the way that he utilizes this program, this concept with his clients. So today is just going to take that one little bit step further. So, all right, once you have buy-in and commitment from your client, then what do you do? So that's what we're going to focus on today. I'm going to pull up a whiteboard. Everybody see my whiteboard?
Yes.
Cool. So first thing that I would say, whoops. As Leroy talked about last week, this is a different mindset, a different way that a client is going to be looking at creating their financial plan. And so it's not a set it and forget it type of plan. It is not a do it one time and then forget about it and do nothing. It is an active plan that they are going to interact with regularly. And so having their commitment and having their buy-in is absolutely crucial to this process. And so I would say the very first thing that you need to make sure is that you have their commitment. You have their agreement that they understand the process, they understand what this is, they're committed to working with it and staying involved in the process, because if they're not, then it's not going to work for them. So the most important thing is that you have their commitment that they're going to work the system and they're going to work the process. So with that said, I have kind of come up with 3 different keys to the design, or 3 different suggestions that I would have to make sure that you have on your design, or that you make a part of your design in order to get it into underwriting and get the process started for the client. So first, one of the most important things is working with a reputable and a good insurance company. And one of the most important things when we're looking at an infinite banking concept, setting up a plan for that, is that this insurance company is a mutual company. So Dennis talked about previously Ohio National. They have demutualized, they have become a stock company. So a mutual company means the policyholders are the owners. That's what we want to look for in a company that we're going to use for infinite banking. The second thing that we want is non-direct recognition. And essentially what that means is the company, if you were to take a loan out of your policy, that company is not going to directly recognize that you have taken a loan out on that policy. And when time comes to pay the dividend, they're going to pay your dividend as if you had not taken that loan out. So we all know that a big part of infinite banking is that you're your own banker. You're constantly moving money in and out. And so the benefit of working with a non-direct recognition company is that they don't recognize when you've taken a loan, and they're going to pay your dividend, and your cash value is going to continue to grow as if you had not taken that loan out. The third thing that we want to look at in an insurance company is that they have a solid history of paying dividends. These 3 things are pretty important, most important when deciding an insurance company to work with. One America obviously has all of these. They are a great company to work with in terms of infinite banking. They are a mutual company. They do non-direct recognition, and they have a solid history of paying dividends. They've been around, I'd say now, I think 145 years, and every single year they have paid a dividend. So through Great Depression, through the Great Recession, through COVID, every year they paid a dividend to their policyholders. So with that said, those are the three keys in an insurance company that you want to look for when you're starting your infinite banking concept plan. As far as the specific plan itself, the design of the case itself, I've got three things that I would recommend that you look at and that you make sure you make a part of your design. So, hey. There we go. So keys to designing your case. The very first and probably most important is that it has the paid up additions rider. That is a rider that you add on to your base policy that's going to allow the client to put additional funds and additional cash into their policy. With One America's rider, the minimum in order to have this rider on the policy is that they're putting in $10 a month, which is $120 a year, into the paid up additions rider. They can put more, but they have to put at least $10 a month into this rider in order to have that on there. We'll talk about this more when we go through an actual illustration, but it's good for you to know the maximum of what somebody can put into the paid up additions rider. So minimum is $10 a month. You can put in anywhere between the minimum and the maximum. The maximum in the first year is 10 times the base. And we'll talk more specifically about what that actually means. But in the first year, they can put into the paid up additions rider 10 times the amount of what the base premium is. Then beyond that, in every year after that, the maximum you can put into the paid up additions rider is 3 times the base premium. Again, we'll talk about what that actually means in a little bit. So first thing, paid up additions rider. Again, we'll talk more in detail about what this means, but a 60-40 split. You'll probably hear a lot of people talk about 60-40 split, 50-50 split, 75-25 split. What that means is that's determining how much of their annual or monthly premium is going towards the base premium and how much of it is going towards the paid up additions rider. So typically when you hear a split, a 60-40 split, we're talking about 60% of their premium is going into the paid up additions rider. 40% of the premium is going into the base. So say, for example, their annual premium is $10,000, $6,000 of that premium we're going to allocate to the paid up additions rider, and $4,000 of that premium we're going to allocate to the base. So that's what they're referring to when they talk about a 60-40 split. 75-25 would be 75% to the paid up additions, 25 would be to the base, 50-50 equal. And again, we'll talk more about that when we go through an actual case. All right, second thing, not a modified endowment contract. I'm guessing most of you have heard of a modified endowment contract, Mech, and probably in the context of Mech is a bad thing. We don't want a Mech. Make sure the policy doesn't Mech. And for these purposes, for IBC, that's true. A Mech is not a good thing, but don't always think of a Mech with life insurance as 100% a negative thing. Essentially what it means is the IRS has put a limit on the amount of cash you can put into a policy. Anything that goes beyond that limit, if you take a withdrawal or a distribution, it's going to become taxable. So obviously with the IBC, again, the main goal is to be able to take distributions, withdrawals, and if that becomes taxable, that kind of takes away the sizzle or the benefit of using this program. So when we're talking about infinite banking, modified endowment contract, Mech, we don't want that. That's not a good thing. If you're designing a policy, a life insurance for somebody who is purely only using the policy for legacy, death benefit, not planning to take any distributions, modified endowment contract doesn't matter. Okay. But for IBC, we do not want it to be a modified endowment contract. Third thing, this isn't an actual design factor. You didn't spend hours running illustrations. I cannot tell you how many times, and I'm guilty of this myself. There are so many different ways that you can run an illustration. There are different riders you can add. There are different tweaks. There are different amounts that you can put here versus here. I found myself spending an hour or more on an illustration and being like, wow, what did I just do? Where did that time go? And we've actually seen cases where people have spent 2 hours designing an illustration, running a case, tweaking this, tweaking that, then putting it through underwriting, and the client got declined. So all of that tweaking, all of those hours of work was wasted. So it is important to design a case beforehand, make sure that the client understands what they're doing and they're committed to the process, but spend your time with the tweaking and with the try this, try that, put this here, put this there. Do that once you know that they are committed. They do the underwriting process, they're getting their parameds done, and B, that they are insurable. You're going to be able to go forward with this. They're not going to be declined. You spend hours running these illustrations, they get declined. You're not getting paid for that. So spend an appropriate amount of time running an illustration, designing the case, so that you can get them in underwriting and get them approved and understand what their rating or their class is going to be. All right. So now that we understand the basic keys to what we're going to do, now we're going to ask the client there are 4 questions that you're going to absolutely want to ask your client. And these are important to make sure that you have before you even start this part, before you even start the design. Maybe, there we go. So here are 4 questions that I recommend that you ask the client. You may have more, you may have fewer, totally up to you. These are just some that I have found you're going to need and I think will be very helpful. So first is just demographics, which you may already know. The most important, obviously, are age and gender. Second, this one is really crucial. Are you a smoker? Obviously, since this is life insurance, whether or not they're a smoker, a tobacco user, marijuana user, that is going to affect how this plan works for them. So if you've gone through, run illustrations, submitted a case, assuming that they were not a smoker, and then turns out that they are, that really affects how we're going to be able to design this for them and how it's going to work for them. So that's really important to know ahead of time and at the beginning. Third, whoa. Third is ask them how much they can contribute towards this plan monthly or annually. You don't have to lock them into this number. This is more just so you can get an idea of what do they have available to contribute towards this? Where are they in their thinking of how this program is going to work for them? Because if they say, this sounds awesome, I want to do this, sign me up. But then they're not thinking in terms of, they're thinking about it as, well, this is just a set it and forget it type of thing. You want to make sure that they understand and identifying an amount that they can commit to putting towards this monthly or annually. That's good to gauge their commitment. And that's also good for you to be able to design a case that can work for them. If you don't have any idea, you don't want to come back to them and say, all right, here's your plan. You're going to have to put $1,000 a month towards this, when maybe in their head, they were thinking more like $300 or $400. So again, you don't have to hold them to this number. This is just a good way for you to gauge a baseline of where to start. I also said lump sum. So one of the great things about this program with the paid up additions rider, you have the ability to put in a lump sum to kind of help the policy grow at the beginning with compound interest. The more you put in the beginning, the greater that compound interest is going to work for you. Don't have to have a lump sum, but if they have it, if they're thinking about it, it's good for you to know that beforehand. And if they weren't thinking about it, it's good for them to think about it as well. Last thing that you want to ask your client is, have you had trouble getting life insurance previously? And it's up to you if you want to ask this question. This is more of for somebody that maybe you don't know, more of just a, save yourself some time. If they're all on board for this, you run illustrations, you submit it, and they're like, oh yeah, every time I've tried to get life insurance, I get declined. Okay, well, that's good to know. Or this is also really helpful for you to know in your field underwriting of whether you're going to put them through accelerated underwriting or whether you're going to go through full underwriting. So you can ask it, you cannot ask it, totally up to you. I just think it would be a good thing for you to have an understanding of where they are in their health and whether or not they've had issues in the past.
Hey, going back to number 3.
Yep.
If so let's say I designed my plan, just for sake of this argument, as a 50-50 split, and I say I want to put $500 a month towards this, and then next year, for whatever reason, I can't. I can bring that down to $250 or $260 a month.
Yes. And we'll talk more about that when I pull up an actual illustration. But yes, the great benefit to using the paid up additions rider is this becomes flexible. So remember here that the minimum is $10 a month. You can put more than that, but the minimum that you have to put in is $10 a month. So like Dennis said, it's very flexible. If any given month you can't put in the full amount, you could just drop down to the $10 a month. And then the year after that or whatever, you could use this and overfund to catch up. Does that answer your question?
Yes, thank you.
All right, any other questions? Okay, I'm going to
Colleen,
yeah.
I put one in the chat. I don't know if you can see it. I'm just wondering, if you wanted to do 10 times right up front, you still have to pay your $10 per month, correct?
Correct, yes. I
Okay.
mean, you'd probably make that as part of the lump sum.
Could
Okay.
I ultimately drop the rider? Probably.
Yes, you can cancel the rider.
Do you have to give any kind of notification to One America that you're going to be super funding this month or anything?
Nope. You there are two ways that you can fund or put into your paid up additions rider. One, you can just go online and put in your policy number and your bank information, and it will draw out of your bank to put into your paid up additions. Or you can call One America Policy Service, give them your bank information and say, hey, I want you to draft this much. But you don't have to give them a heads up. You know, hey, probably in year 4, I'm going to put an extra $10,000 in. You don't have to do that.
All right, so you could go into your policy online and say, okay, this month I want to add $2,000 extra.
Yep.
Okay.
And so we talked before about one of the other important things is making sure it's not a modified endowment contract. If you put in paid up additions into your policy years down the road, there is potential that it could become a modified endowment contract. Again, we don't want that to happen, but One America has your back and they will let you know, hey, if you put this money in here, it's going to become a modified endowment contract. Do you still want to do that? And so they will alert you beforehand. They won't just kind of let you fall into that trap and then you're SOL. So they will let you know if it's going to become a modified endowment contract.
Colleen, is there some kind of line of accounting that you can follow along to see if you're getting close to that, so you can judge what you're going to be putting in? Hitting the Mech?
Yes.
Hi.
Probably. Yes.
Yes.
Okay, thanks.
All right. Any other questions before I go to an actual illustration?
Colleen, real quick, with the online that you have with One America, can you see the balance in your plan at all times?
Absolutely. Yep.
Perfect.
Colleen, can the minimum be contributed as a lump sum, or does it have to be contributed monthly?
It can be a lump sum. Any other questions? All right. Can you see my OneSource screen?
Yes.
Great. All right. So we've got buy-in from the client. We've got the answers to those 4 questions. And we've got a good insurance company, mutual company, non-direct recognition with a good history of paying dividends. We're ready to design our case and to submit it to underwriting. So I'm going to go in here to Sales Connection. And this is an actual case that I was helping somebody with a few weeks ago. I'm going to change her last name just for fun. She was is a 40-year-old female. She's married. She's got 2 kids. Her husband owns his own business. I want to say like a printing company, something like that. And she has just recently gone back into the workforce. Kids are in school. She's going back to work. And so essentially that money that she's going to earn with her paycheck is kind of extra or something additional for their family. And so she had heard about infinite banking, and she and her husband decided, well, we should use a portion of her income, a portion of what she's going to be earning towards this program. So we're going to move forward with Sharon and design a case for her. So we went into Sales Connection. Most of you, I'm sure, are familiar with Sales Connection. If you have any questions on this along the way, shout out. So I'm going to choose Illinois and then whole life and hit find available products. You'll see here now that there are 3 whole life products that pop up for One America. Whole Life 121, Whole Life 95, and Whole Life Select. Whole Life 121, that's going to be a whole life policy that pays till age 121. Whole Life 95 obviously is going to pay till age 95. And then Whole Life Select, that's the limited pay option. So single premium, 10 pay, 20 pay, pay to 65, or pay to age 70. Whole Life 121 is best going to be used for somebody that is looking for death benefit. There's a longer period of time in which they're paying their premiums. And so they're going to be able to get a larger death benefit for the same amount of premium as if they were to put in a Whole Life 95. That's going to be best for people that are looking for cash value. Time period in which they're paying the premiums is a little bit shorter. So the cash is going to be able to grow faster, but you're not going to be able to get as high of a death benefit as you would with Whole Life 121 in the same period or with the same premium. So the key for you to take away from all that, we're looking for cash value with the infinite banking concept. Death benefit is a great side benefit. It's not necessarily important to this program. So because we're looking for cash value growth, we're going to use a Whole Life 95 product. There are different reasons why you might want to use Whole Life 121 or Whole Life Select for infinite banking. Just know that that's out there. You can use any of these products for the program. I would say start with Whole Life 95. That's where you're going to want to go with this. So we're going to choose Whole Life 95. We're going to go into the quotes and illustrations. First thing we're going to do with Sharon is just choose her rating class. Everybody has different methods or thought processes around this. My thought process is I'm going to quote them a little bit worse than what I think they are. It's always easier to go back to them and say, hey, you're a lot healthier than we thought. Great news. Versus, we ran you at the best rating and you're actually not that healthy. So it's going to be a little bit more expensive. So I know that she's pretty healthy. She has term insurance, so she is insurable. I think that she could get preferred. I'm going to run it just one less than that. So I'm going to run her at Select. Next thing we're going to do, oh shoot, I closed that. So the 4 questions that we're going to ask Sharon, demographics. So her age, 40, she's a female. Second question, are you a smoker? She is not. So that's why we were able to choose Select non-tobacco. How much can you put towards this plan monthly or annually? And do you have a lump sum? They talked about she's going to be making $30,000 a year. They wanted to allocate about 1/3 of this to this policy. So they're comfortable with putting $10,000 a year into this policy. They thought maybe in the first year, they might want to do an extra $10,000 lump sum at the beginning, but they're not really sure. So $10,000 a year with potentially a $10,000 lump sum at the beginning, but unsure. That's the 3rd question. 4th question, have you had trouble getting life insurance in the past? Nope, she's very healthy. She has term insurance, so that's not a concern for me. So we're ready to move forward. Remember how we talked about the split, 60-40 split, 50-50 split. This is where that's going to come into play. This benefits and input methods section, this is talking about the base. So we talked about 60-40, 60% going to paid up additions, 40% going to base. This is where we're going to input the amount that goes to base. So instead of base face amount, remember, we don't really care about death benefit as much. We're concerned about the premium. So we're going to say total modal premium. It'll be tempting to choose base modal premium, but always choose total modal premium because there are some things that we might need to do to avoid a mech. And we want to make sure that we still don't go over her premium amount that she's comfortable paying. So we're going to choose total modal premium, which determines what's the base premium that we want to pay. So she said they're comfortable with $10,000 a year. So 40% of that, we're going to say is $4,000 a year they're going to put towards the base. We're going to leave dividends, paid up additions, index dividend allocation. I won't go too far into this. Essentially, this is a way for your client to allocate anywhere from 0 to 100% of their dividend to be matched to an index, to the S&P 500 index. So it's a way to multiply one's dividend that they would get each year from One America. It could be 0 if the market doesn't do well. It could be doubled. So this number here, you're just going to input a number anywhere from 0 to 100%. I know some people always put 100%. You know, some people always put 0%. I'm just going to put, 50, just to kind of be in the middle there. This can be changed each year, so you're not necessarily locking into this for the client. We're going to leave everything else as is. Solves are a great thing, but again, we don't even know if she's insurable. We don't know what rate she's going to get. We want to get something into underwriting and be able to deal with real numbers before we spend all this time working on solves. So I'm just going to leave that as for now. I'm going to leave it on annual mode because they want to do annually. Now I'm going to go to the riders page. Sorry, I know I'm talking fast. It's 9:50, so I'm just trying to squeeze it in. All right, this is the page with riders. All of these riders are great. Waiver of premium, child rider. I'm not going to talk about those today. Paid up additions rider is the one that we want to talk about. So remember, in our case design, paid up additions rider is one of the important things that we want to make sure is a part of our policy. So when we check this box for paid up additions rider, a menu or more options pop up for us to input data. So again, go back to our splits. We talked about a 60-40 split. $4,000 is going into the base and $6,000 is going to go into the paid up additions. So we're going to click this modal premiums button to identify how much we want to allocate towards the paid up additions. So here we're going to say 6,000. So $6,000 a year, 6,000 of their annual premium is going to go towards paid up additions. For her, she's 40 years old. She's not necessarily going to want to pay the full $6,000 when she's older, when she's retired. She wants to kind of front load this, or we want to front load this for her so that her cash is going to grow at the beginning faster. But once she's retired, she doesn't necessarily want to have to put in this much, or doesn't want to feel inclined to put in that much. So I'm just going to change this to, for the first 30 years, so until she's 70, we're going to have that paid up additions rider on there. Then in the years after that, I still want her to have the option to put money in if she wants to. And so I'm just going to drop it down to that minimum. Remember, the minimum was $10 a month or $120 a year in order to have this rider on the policy. So after the first 30 years, I'm just going to drop it down. The other benefit to doing it this way is this can help you avoid a Mech. Not putting as much cash into the policy can help you avoid a Mech. So I'm gonna go ahead and hit OK, and that will add the paid up additions rider on there. I know just from running this before that this is going to Mech. This is going to become a modified endowment contract. I'm putting too much cash in, and so it's going to Mech. One of the easiest ways to avoid that or to combat that is to add death benefit. So essentially what a Mech is saying is you're putting in too much cash into this policy and not enough death benefit is being purchased. So to combat that, we're going to buy more death benefit. So the way I'm going to do that is use this same insured term rider here. This is essentially exactly the same policy as getting a separate term policy, but we're just adding it to this whole life to avoid a Mech. So I'm just going to add a 10-year term for $500,000. So we're buying more death benefit to avoid a Mech. That's it. These two riders are all you need. I'm going to hit illustration, and it's going to pop up hopefully. Yep. Can everybody see that page that popped up?
Yep.
Great. Illustrations are a great thing and a terrible thing. And remember that they are just that. They are just an illustration. They are not a statement. They are not, this is what's going to happen. They're a great way to illustrate and to show what could happen with one's policy. This page here that I went to, tabular detail, this is a good page for you to go to understand the illustration, understand what's going to happen with the policy. Really quickly, there's a guaranteed column and a non-guaranteed column. This non-guaranteed column, the difference is that this is including dividends. Obviously, dividends are not guaranteed. They cannot be contractually guaranteed. So they're in a non-guaranteed column. However, with One America, because we know that they are consistent in paying dividends, they've never not paid one, it's pretty safe to say that we can go off of this non-guaranteed column. So when I look at illustrations, I'm looking at this non-guaranteed column. All right, first thing we're going to look at is we see here, here's their $10,000 a year that they're putting in. We have that same insured term rider for 10 years. So after 10 years, it's going to drop a little bit. And then remember, after 30 years, we had that, we had the paid up additions rider dropping. Here's a key to note. This $10,000, again, remember that only 40% of it, $4,000, is the base. That's contractually required to be paid. The $6,000, that's flexible. So her husband is a business owner. If he has a bad month or a difficult month and they need part of her $6,000 to go towards household expenses, she can do that. She doesn't have to put it in here. She doesn't have to put the full $10,000 in here. It's flexible and allows for growth as well. This column here, the benefit to using the paid up additions rider is that your cash value is going to be available to you much earlier. You can see here in the guaranteed side, there's no cash value at the end of year one. When we're using paid up additions, you're going to have some cash value right from the beginning. All right, so that's the first option. That's their $10,000 a year that they wanted to allocate towards this. We did a 60-40 split. Honestly, I would go and submit this right now. This is what I would submit to underwriting, get them in underwriting, get their commitment, and get things moving. The only other thing I might suggest is remember how they said they might want to put in a lump sum. They might want to put in an extra $10,000 at the beginning. Great. Let's go ahead and show what that would look like. So again, everything is the same on the illustration. We're just going to go back to this PUA rider section, paid up additions. And you have two different places where you can input a lump sum of premium to go into the policy. One is a 1035 single premium. That would be if, that would be if the money is coming from another existing life insurance policy. So say they have, a whole life or universal life policy at Northwestern Mutual that has $10,000 of cash value in it, and we want to do a 1035 to move that over to this policy. That's where you would put that dollar amount. They just have a non-1035 lump sum. So this is just an additional lump sum that they have sitting around, or extra money that they have that they would want to contribute to this. So we're going to put that $10,000 into this non-1035 single premium. We're going to leave everything else as is and just run the illustration like that. So we can see here, even with that additional premium, so we're going to add an additional $10,000, it still doesn't mech. That's good. So we can look here, first year they're putting in 20,000. That's their first year's premium plus that additional 10,000. And then going forward, it's the same as before, except you'll notice here that cash value is growing a lot faster. So this one on the right here, this is without that initial $10,000 dump in. This one over here, this has it. And again, because of compound interest, putting money up front or having it front loaded is only going to help with growth. They don't have this, that's no problem. This is still a great plan for them. But if they do have that, they do have any sort of lump sum, putting it in here, getting that compound interest, getting that growth started early is only going to help them. So I take back what I said. I would actually submit this illustration here because this includes that additional premium in it. I went through that really quickly. What questions do you have?
So Colleen, the net cash value, that's the amount of money they can pull out as they need.
Sorry, I was reading chat messages. That's terrible. Say that again.
So the net cash value, that's the amount of money that they can draw from the account as they need.
Yes. So this column here, this total net cash value, that's where they're going to be looking to be able to take distributions, a loan. So this $14,000, they can access that. So essentially their $10,000 lump sum that they've put in, they can essentially get that back. But because One America is a non-direct recognition company, this cash value is still going to continue growing as if that $10,000 was still in there. Lamar had a question. How are you combating pushback on funding till 95 years old, having the PUA being the only funding needed after retirement? So still adorable. It is adorable. This is where I would say there are 100 different ways to, there are 100 different ways to design a case. You can have the premiums stop at retirement. So a lot of times people will say, well, I only want to do this up until retirement. I don't want to have a contractual obligation to be able to pay or to have to pay this after retirement. Great, we can do that. We can either use a whole life select, or we have the ability to design a whole life 95 to have the policy pay the premiums so the client isn't paying the premiums out of pocket. So yes, you could do whole life select and go to age 70, or you could design a whole life 95 to have the premiums offset at a certain age. Again, like I said before, there are so many different ways to design a case. Don't spend your time, don't spend hours and hours doing that necessarily on the front end. Wait until you can make sure that they're approved, and then spend your time doing those tweaks, identifying, all right, you want to stop paying at this age? Great, we can do that. In both cases, appear that the break-even point isn't until the 12th year, even with the extra 10,000. Any reason why? I think it's because, let me look. So 12th year.
Does my question make sense, Colleen?
Yeah, nope, it makes sense. That's a good question. I don't have a good answer for you. My only answer is break even doesn't really matter. I know it's a great way to kind of measure where you are in the policy, but it doesn't necessarily matter because of the fact that we're going to be putting in and out and in and out. I personally don't think that break even necessarily matters, but I totally understand your question.
The reason why I'm asking is because like a lot of the information that I've gotten, whether it's reading or videos on YouTube and other places, it seems like they stress the break-even point much earlier, like year 3, year 4, year 5. And if it matters, I guess the reason why I'm asking is because someone asked me why it's taking longer. I at least want to know what the variables are and how they're working.
Your sound is messed up. I couldn't totally hear all that.
I'm sorry. I was just trying to understand the variables at work in case someone asked.
Sure.
You know, because other sources stress a given point much sooner.
Sure. Yeah, I don't have an answer for you right now. Let me,
So Colleen, I caught a client that kind of asked the same question. The question was, what was the cost of this? And if that was worth it to do it. I sit down with them. We went with, I kind of separate the cost of the basic policy versus the PUA rider. And because my client already has a whole life, then she's putting data premium, basic premium into a whole life. And we went to see how much that will cost her, how much cash value she will have in that one versus the PUA rider. And with actually the client was the one that came out with his own analysis of cost. And he said, if I put the money of the PUA rider in a normal account and I invested and I get 4 or 5% a year, how much I will get in 20 years. And he did that calculation himself. He's an engineer and they love numbers. He put the money in a normal 4% or 5% account, took out the taxes, came out to be almost the same amount of money that we were having in the guarantee cash value. And actually he said it's actually more because he wouldn't have or his analysis didn't have the taxes out yet. So he said this is no brainer, and look at the death benefit and the end of the same period, and she had a lot of life insurance to leave to the kids. So it was after he did his own analysis of cost, he said this is a no-brainer. You get the money guarantee, and that is not even using the money. It was just the investment. And you have the plus of the insurance that you have there, and you have the plus of using the money. So that is how I answered that kind of questions to my clients.
Yeah. The other thought I had, John, was if you look at this page here, the itemized premiums and benefits, this page is going to break down exactly where the premium is going. So their $10,000 premium, this is how it's being split. So $3,640 is going to the base, $6,000 is going to the PUAs, and $360 of that is going to the same insured term rider. So because on both of these, the same amount of premium is going into the base and the paid up additions, that's why I think the break even is the same. The benefit to this one though is just that $10,000, that initial lump sum is going to help obviously the cash value start growing from a higher number. So of this 14,000, they can take back this 10,000 and still have this continue growing. Does that make sense? So it's still going to grow at the same rate. It's still going to have a similar break even, but this is just going to grow from a larger number.
Okay, that makes sense to me.
Yeah, so further down, I mean, even though, so in years at the end of year 30, with that $10,000 lump sum, their cash, obviously, if they hadn't taken anything out, cash value would be $530. Without the lump sum, it would be $498. So it's $32,000 more, even though they just put in an additional 10,000. Jeanette said, can this be used with minors? Absolutely. And this is a place actually where we see, you know, if somebody is declined or they're uninsurable, that's all right. Do they have any kids? Start this with their kids. Just have the parent be the owner, have the minor be the insured, and they can use this program with the child as the insured. But yes, it's also a great thing to start with a kid. Have them start their own bank when they're young. Other questions?
Colleen, if you do it on your kids, though, you can't build up the kind of cash that you're looking to build.
Sure. Yeah, it's not going to be.
It's not going to be something you're going to use. It's something that you can help them get started in their life.
Well, you could use it. I would say only do it on the kid instead of the adult if the adult is uninsurable. But yes, this is a great thing to start with a minor. Having the paid up additions rider on there for the minor is a great thing because of its flexibility. You know, when they're teenagers, they don't really care about this. You're setting them up. But when they're in their 30s and their 40s, if they have the paid up additions rider and they're making a great income, they can put in a significant amount of money into the paid up additions rider and have that cash value for themselves. Anything else? You know, it is well past 10. But again, if anyone has specific cases they want to go through, if they have specific clients they want to talk through, sales desk can help you. Christina is great with running illustrations. She is great with solves and understanding how to avoid mech if you just can't figure out how to get something not meching. She's great at playing around with those. I'm willing to help you. I'm willing to sit down with you and go through an individual case as well. Just got to raise your hand and ask. All right, so if we don't have any other questions, I will say peace out.
Thanks, Colleen. Good job.
All right.
Thanks, Colleen.
Are you sick?
A little bit.
Yikes.
I'll get over it.